Welcome to 25 for 25, the CreditSights 25th anniversary edition of our No More Risk Better podcast.
5 episodes, 25 questions, insights from our expert analysts and industry veterans.
We revisit the origins of CreditSights, share hard-won lessons from across cycles, and unpack the art and science of credit analysis.
We'll highlight how we collaborate and explore the future of credit research, what's changing, and what still matters.
If you want to know more so you can risk better, you're in the right place.
Let's dive in, celebrating 25 years of CreditSights.
Hello, everyone, and welcome back to the CreditSights No More Risk Better podcast. This is Winnie, Cisar, Global Head of Strategy at CreditSights, and today we have a very special first episode in our 25 for 25 series celebrating CreditSights' 25th anniversary. And with me today, I have 3 of our esteemed European analysts, all of whom joined within about 3 years of each other in the early days of CreditSights. So we are going to get the inside scoop from Simon Adamson, our head of European financials, Andy Belton, head of European basics and infrastructure, and Andrew Moulder, our head of European utilities. And I do have to say that you guys must have joined while you were still studying in university have been around CreditSights for as long as you have. We also have Zach Griffiths, our head of U.S. investment grade and macro strategy. And we're going to talk about the early days of CreditSights and some of the lessons learned. So thank you guys for joining me today. Simon, I would love to start with you. You are truly the heart and soul of our London team and London office. What was the vision behind founding CreditSights? You were already involved in the world of credit research as CreditSights was getting founded. Can you give us an overview of what was it like in the early days and before CreditSights came around?
You make it sound so long ago. What was it like in the early days? I think I'm struggling to remember some of it, but I think back in,
Well, the
in
facts,
2000,
Simon.
back in 2000
Everything
when
used to
CreditSights
come by
was founded.
facts, if you remember.
Sorry?
Everything used to come by facts, if you remember.
Yeah, fax was a new invention, I think, yeah. Well, back in those early days, I think the vision was just very simple. It was to provide independent credit research to what was basically an untapped market. And if you think back to 2000, this was actually a pretty new idea. I mean, no one knew if it would have any legs. Obviously, we're still going, so it had some. And I think part of that vision was to gather together a group of senior, experienced credit analysts and just provide good quality research. No axe to grind, no trading operations, no assets under management, and a much bigger team than you would find at any of the sort of individual banks that were providing credit research. And of course, back then, there was a lot more sell-side research. Most of the investment banks had teams that were publishing credit research. And now a big question and the big hurdle, I guess, when we founded CreditSights was, would anyone actually pay for the service? Because the sell-side research was perceived as being free. Now, of course, it wasn't actually free. Someone was paying for it somewhere, but it wasn't unbundled and clients weren't explicitly being charged for it. So we had to get past that hurdle to begin with. And I think maybe the one thing that helped CreditSights in the early days more than anything was if you remember, Eliot Spitzer, who was the New York State Attorney General, was sort of sparking a debate on bias in equity research and setting up independent research. And that really helped us on the credit side as well. So I think the idea of independent credit research took hold far more quickly than I think even we had hoped at that time. And that's what really spurred the sort of development of the firm. So, it's fairly simple vision, but it was going into sort of unknown territory really at that time.
Thanks, Simon. It's interesting to think back and kind of distinguish between what we do at CreditSights and the sell-side research. I think some of those challenges or considerations have been brought up recently. I remember going through the MiFID II exercise back at Wells Fargo on the sell side, and so I think there's some interesting, I guess, developments recently that are almost similar to what we saw back then. I know you kind of outlined one of the big moments or perhaps drivers of CreditSights coming to be, but can you share maybe a defining moment in terms of maybe whether it was what made it clear that the model was going to work or anything else that kind of sticks out to you in the early development days outside of kind of what you just outlined for us?
Well, I guess for me personally, and probably for Andy and Andrew as well, was the the opening of the London office at the end of 2002, beginning of 2003, because that's where we all got involved. And obviously, CreditSights expanded, was founded in the US, expanded out into London, beginning of 2003 to start covering European credits. That's where it all started for the three of us in terms of CreditSights. In terms of defining moments for the firm, I guess there've been quite a few, but the one that sticks in my mind, I guess, is the global financial crisis. Obviously, that started 2007, which was still fairly early on in the history of the firm. And I think what we came to realize was that within bounds, you know, global financial crises are actually quite good for CreditSights because you get a lot more readership. You get a lot more people that are suddenly concerned about credit. You need to be able to show people that you've got sort of senior analysts that have lived through previous crises, although I don't think anyone had seen anything quite like what happened 2007 onwards. But, for example, just in banking, we'd been through the Nordic banking crises of the early 90s. We'd seen LTCM. So we had analysts that had a lot of experience in that. But as long as not too many of our clients are actually getting caught up in whatever crisis is going on, those sort of things actually again, and we got a lot of readership, we got a lot of more publicity, much more visibility because of what was happening 2007, 2008. So I think that was probably for me the defining moment in the development of CreditSights.
I think that the kind of counter cyclicality of CreditSights has been really nice for me personally, joining from a bank which is highly cyclical. And Simon, it seems like banks are always ground zero for these crises, or very frequently ground zero for these crises. So I'm amazed that you are still kind of able and willing to stick with the banking focus. Don't you want to shift and cover
Well,
consumer or something else?
Well, I guess it's what makes it interesting. I do remember back in 2006 talking to John Raymond, who covered the banks with me at that time, and we were saying we really just can't think of anything to write about. The whole sector is so boring. There's nothing happening. Everything is so tight. What are we going to do next? Do we even need to cover banks? And then 2007 onwards, it's been a roller coaster ride. I mean, up until even, well, obviously a couple of years ago, Credit Suisse and the US regional banks. So, but I mean, the good thing is you're always seeing something new. Just when you think you've seen every reason why a bank may get into trouble and every aspect of what a bank might do, something new comes along, some new risk, some new products. So I think that keeps it fresh and that keeps it interesting. And it can get a bit hairy at times, and it can take over your life from time to time. But it's been quite an interesting sector.
Yeah.
Yes, absolutely. Never underestimate the potential for financial engineering to really add some hidden risk to the system for sure. So, Andy Belton, I want to go to you next. I know that a defining moment in CreditSights' early development, at least for Simon and Andrew Moulder, was, interviewing you. But Andy, how has your approach to credit research and analysis evolved over the past 25 years or so?
That's a good question, actually, Winnie. And I think I'd probably answer it in two ways. The first is actually to say what hasn't changed. And one of the things that's been constant in credit analysis, at least for non-banks or non-financials, has been the importance of cash flow analysis and modeling. I first heard the phrase cash is king when I turned up at a now defunct UK merchant bank in the late 1980s. But I think it's a phrase that is as resonant nowadays as it was back then, whether or not you're looking at a typical, for example, a chemicals behemoth like BASF or a small paper producer like Federagoni, which is struggling with a 4 times leverage profile. And I think one prime example of the importance of cash flow is actually looking at the European high yield construction space, which is a sector that I've got first-hand experience of. Now, this is a space that's basically seen a plethora of failed and bankrupt companies like Abengoa, Astaldi, CMC Ravenna, all of which have disappeared through essentially cash flow pressure. This is a sector where EBITDA numbers can basically be plucked out of the air. And I think it's a very solid illustration of the fact that the devil is in the detail. And the detail here is in the working capital statement, and it's in the free cash flow lines. Now, in contrast to that, I think one of the greatest changes that I've seen in credit research since I've been at CreditSights has been the changes in the way we approach relative value. When I first turned up in 2005, the European bond market was a great deal smaller and less liquid than it is now. And actually, we express relative value through CDS recommendations. Now, the global financial crisis put paid to that market. It completely devastated IG CDS, with the result that it actually accelerated our move towards using bond recommendations to express relative value. And of course, that's a process that is still ongoing and in fact is even accelerating as we look at the present day. So I think I would say that's possibly the biggest change, is more on the relative value side rather than the fundamental research side.
Yeah, I think that that's a great point. And the technical aspect of relative value comes up a lot with clients when we have strategy conversations. How are people positioned? Is there liquidity? Is this on the run or off the run? Where on the curve is it? Is it a hybrid? And Andrew Moulder, I know that you have some good experience with the corporate hybrid space, which has really shown some pretty significant growth, especially in your sector of utilities. How has your approach to credit research evolved over the past 25 years or even more recently?
Well, I think what you just said about hybrids is one prime example. There are different instruments now and more complex instruments to look at. It seems like bankers are always coming up with something new to get around some kind of issue that companies perceive they have. And hybrids are a great example of that. I mean, I can echo Andy's comments. Sort of before I joined CreditSights, all the relative value was looking at CDS mostly. And I originally came from an equity background, and I actually found it quite, when I first started looking at credit, it was like, oh my God, with equity, you've got the share price. With credit, you've got 20 or 30 or 40 bonds, depending on what company you're looking at. So it was a slightly different universe for me originally. But I think really the main thing that's changed for me is looking at some different instruments, in a different context, rather than just looking at the CDS originally, and now the bonds. And again, as Andy says, we're moving more onto the individual bond level recommendations, because I think that's kind of what clients are asking for. I mean, it can be quite complex, particularly if you've got some of the utilities I have, and I'm sure Simon's the same in the banking sector, and Andy with some of his names. You do have 50 or 60 bonds that you can pick from. It can be quite difficult to find relative value between those bonds. And I think one of the things Simon said about founding CreditSights with experienced analysts, is an important point, because when you're looking at individual bonds, you need to have contacts in the market that you can talk to and say, well, is there anything strange about this bond that makes this relative value slightly different from the others? Is it, perhaps it's not liquid at all. Perhaps it's a smaller size, so it's more accessible to the retail market and things like that. And that makes a difference. And so I think it's important to have the contacts in the market, which I think was one of the sort of founding things with CreditSights. When I sort of first started at CreditSights, the main people within the business were experienced analysts. Within CreditSights were experienced analysts with years of experience behind them, mostly at investment banks. And that was important, because when you kind of go to a company and say, oh, I work for CreditSights, in the early days, they'd kind of say, who are they? But if you were going and saying, I'm Andrew Moulder, or I'm Simon Adamson, or Andy Belton, they would know who you were and they would speak to you. And that kind of really helped, I think, the growth of CreditSights from where we started to where we've got to.
Andrew, how long did you do equity research before you came to CreditSights? Or how long were you an equties person before you came into the world of fixed income?
Goldman's for 4 years, actually, doing equity research. During the long-term capital management, I was at Goldman's then, and that was quite a hairy time. So I did 4 years there, and then I moved over to the credit side for 4 years as well, and then I joined CreditSights after that. I mean, it's kind of interesting you ask about equity research, because one of the questions you asked Simon was about defining moments in CreditSights history. And I think one of the moments for me very early on was the fact that CreditSights was actually looking to do equity research and credit research, but they found that really the revenue wasn't there from the equity side, mainly because there were a lot more competitors and the banks were a lot more active in terms of the equity research they were putting out and everything like that. And so that sort of really, I think, moved CreditSights even more firmly over to looking at the credit side rather than other areas. And I think that's really where we've grown from there, sort of growing the business on the credit side, more high yield coverage, more special situations coverage and so on. So I think, that was really quite a defining moment for CreditSights, deciding exactly what they wanted to do and where they wanted to do it.
That's awesome. I didn't realize that CreditSights had considered equity research. And I remember in my years at both Wells Fargo and Bank of America, I was shocked at perhaps how few companies individual equity analysts covered, and their titles would be seemingly 4 layers down subsector of their coverage. And I was like, wow, that is incredibly specific. How many companies could there be that you could
Yes.
possibly cover? So I feel like that's really interesting perspective to think about how that was, at least initially considered to be part of kind of providing this independent research and ultimately deciding the banks clearly have it pretty well surrounded, whereas that really wasn't the same case for fixed income.
Yeah,
It
So-
wasn't one of our most successful episodes, I think, trying to get into equity research.
Well, you got to have some of those to make it 25 years in the business. They're not all going to be home runs, right? So Simon, I actually wanted to come back to you thinking about the credit markets over the past 25 years. What, in your view, have been the most significant changes over that time frame since CreditSights has been operating?
Well, I guess in a way, Andrew and Andy have covered a few of those things already. I think, when you think back to 2000 and going back to this issue of relative value, it was actually a deliberate decision by us in the early days not to really get involved too much in relative value, even though most of us had come from the sell side, from investment banks. Partly because we were a bit cut off from that. We weren't sitting in a trading room, but also we just needed to build up a body of research, fundamental research, in order to have something to sell. And therefore, I think we didn't want analysts getting too distracted by trade ideas or by relative value or even by that much client interaction. So it was a different sort of perspective in those first few years. But it didn't matter too much in the end because, I mean, the credit market, relatively speaking, especially in Europe, was sort of in its infancy. I mean, if you think the firm was founded in 2000, I think from what I remember, the euro only came into being in 1999. I think it's 1st of January 99. I don't think we actually got notes and coins in euros until 2002. In those early days, there wasn't really a very developed, euro credit market. It was still pretty much starting off. So that was a very different sort of market, far fewer participants, a much smaller market, probably less liquid, although I think sometimes there isn't that much liquidity even today. But I mean, it was certainly a different sort of market. I think from my sector, from the bank's point of view, things have changed massively, mainly because of the global financial crisis and what happened to regulation after that. But what it meant was that, and going back a little bit to what Andrew was saying as well about companies he covers, is that you have a much more complex liability and capital stack now. So we're looking at a lot of different sorts of instruments, all, some of them very complex in terms of the regulatory background. And what it means essentially is that we've moved in banks anyway from the concept of bailout to bail-in. And that means that investors have to do a lot more credit work, which is good for us, I guess. But I mean, in the old days, you probably bought senior debt from banks thinking it was virtually equivalent to government debt because whatever happened, the banks would get bailed out. Obviously, now you have to do much more credit work on those sort of instruments as well as the more subordinated ones. So, that's been a really big change over the past 25 years in certainly looking at the bank sector anyway. And as Andrew said, that's probably been mirrored in other parts of the credit market as well.
Yeah, I think that's a great point, Simon, especially as we see these surges in new issue supply, especially for some of the more complex or subordinated structures where there are just deals launching left, right, and center. And clients only have so much time to look at each individual deal, go through all of the different terms and conditions. And that's where CreditSights and the broader analyst team does a tremendous job of stepping up and actually getting in the weeds on some of these things amid the absolute deluge of new issue supply. And as Credit Suisse reminds us, it's important to know what you're buying, understand what you're buying, understand how things can go sideways, because unlike the equity market, it doesn't just all go up, apparently.
Well, I
Okay, so
remember,
let's wrap it up. Oh, go ahead.
I remember in the early days, Glenn Reynolds, who was one of the founders of CreditSights, saying to us that, look, as a credit analyst, you can be the smartest guy in the room or the most useful guy in the room. Most of the time, you're going to be the most useful guy, but just occasionally, you can be the smartest guy as well. So you've got to have those two aspects to it.
I think
Yes,
Simon's just
absolutely.
basically taken a lot of what I was about to say. I was waiting to get my opportunity to give the Glenn comment, because that is a classic, but it's also a truism.
Mm-hmm.
It's absolutely at the core of what CreditSights does, is not just be the smartest person in the room, but actually be the most useful.
Yes. And I think that the evolution of CreditSights to be much more client engaged, more one-on-one conversations, all of those things, I think that it really increases the utility and clients who lean on us for meetings and more bespoke analysis, I think, are the ones who really benefit from CreditSights. And also it makes it much more fun for us as research analysts. We just put things into the world and think, who's reading this? Does anybody care? It can get very existential.
And we get ideas for what we can do from clients as well. So it's
Yes.
a two-way process. I remember years and years ago, before the Icelandic bank crisis, which was actually quite a big thing at the time, that we hadn't even looked at the Icelandic banks until a couple of people said to us, "Well, are you seeing what's going on in Iceland? It's an interesting situation. It might be worth having a look." So I flew out to Reykjavik and met the banks, and it was a great couple of years for us, because it was a very interesting story. But we probably wouldn't probably have got into that much later if we hadn't had those conversations with clients where they brought that sort of thing up.
Absolutely, that reverse inquiry can be so powerful and so beneficial to us, and then by default to the broader CreditSights client universe. All right, let's wrap it up with a little bit of a pseudo speed round. Andy Belton, I'm going to ask you first. As you look back through your years at CreditSights, what do you think was the biggest challenge that you overcame?
I think actually Simon's already touched upon it, and it's that classic juxtaposition between market volatility and sort of commercial reality. Market volatility is brilliant for our business. It increases the readership on the website. It increases the reverse inquiry demand from clients. But at the same time, I remember in 2007, 2008, we were all incredibly busy running around producing historically high levels of research, and I think obviously insightful research. At the same time, though, a lot of our clients were seeing really intense financial pressures, and you're kind of thinking from one standpoint, the research standpoint, this is a great thing. From the other standpoint, you're literally going through your roster of clients thinking that hedge fund has gone bust, that one's gone bust, that one's gone bust. And it's that kind of juxtaposition between volatility being great for research, but also having a negative commercial impact is a real sort of memory for me in 2007 and 2008. And actually, I'd say that was also something that was relevant in sort of April 2020, when we were faced with a very different challenge. Similar kind of things in one sense, that volatility was massive. The market was looking towards people like CreditSights for our insights on what this unprecedented pandemic and the lockdowns that were resulting from that would have on the markets. But at the same time, we're trying to challenge, or to balance the challenges of running a business. And for example, you've got salespeople making loads and loads of cold calls from their kitchens. At the same time, you've got the research team trying to coordinate 25 different voices in a research-led strategy article, for example. When you're dealing with 25 different locations, whether it would be a kitchen or a lounge or a dedicated office. So I think both of those two examples, I would say, are really good, clear illustrations of the kind of challenges that I faced during my CreditSights career, but also the way that CreditSights has reacted to it. We tend to be very nimble, and I think we are incredibly innovative in the way that we operate when facing with these kind of challenges.
Yes, absolutely. I mean, I think that we all have a little bit of PTSD looking back at April 2020 and the things that we were doing at the time, especially for anyone who might have had kids at home. I remember my 6-month-old being on the dog bed and me just throwing balls at him to try and entertain him while I'm trying to do a conference call and figure out what the Fed is going to do next. That was a true delight. Andrew Moulder, I'd love to hear what your biggest challenge was as you're looking back.
I mean, I think the guys have covered it really. Sort of volatility in the markets was a big challenge, and dealing with what that meant, you know. And for me, actually, I mean, maybe it's, yeah, well, as a utility analyst, most of the names I cover are, when I started covering them, they were all AA. Okay, so they've gone down slightly, but occasionally you do actually get utilities that go bust. I covered British Energy. I was also covering Abengoa when that went bust. And I'm covering Orsted at the moment, which is not going bust, but it's very volatile because of what's going on. And that's kind of been a challenge, dealing with slightly different things and adapting to them. And as Simon said, you start off and you have a meeting with a client about something, and actually, okay, you've got an idea how it works, but you might not have that much detail, and the client gives you a little bit more information, and then you start to build up a better picture, and you can grow your knowledge base from the conversations you have with clients, and that really helps you. It kind of, the challenge is overcoming a new situation, and as you get more familiar with that situation, and you get that through speaking with clients and writing research and getting feedback on that research, that really helps you as an analyst. I think that's kind of one of the big sort of challenges for me, kind of looking at new situations evolving in my sector, and it's great. I really enjoy it. It makes the job exciting. As you say, Winnie, sometimes you're so busy, you're up all night, and you're up at the weekend, and you're working when you're on holiday because the situation has come up. But I find that exciting, and I enjoy doing that, really. I mean, I wouldn't want to do it every day, but I enjoy doing that when those situations come up.
And therein is a very big part of Andrew Moulder's benefits to CreditSights, because he manages to make utilities sound exciting. I think that's a real talent.
Yeah, it's the first time I've heard the words exciting and utilities analyst in the same sentence, I think.
Oh my gosh, I love it. I also frequently think that a team of research analysts would also make the most excellent group of private investigators, because we know how to find out information and be a little bit slick about it, a little bit sly about it for sure. So maybe if this CreditSights thing goes sideways over the next 25 years, we can all reconvene as private investigators and focus on that part of the world instead.
I think in 25
Forensic
years,
accountants.
we're probably going to be retired, I would think, aren't we, Andrew and Andy?
I was going to say I might need the help of a Zimmer frame at that point, Winnie, but nonetheless, I'll be there.
I love it. I think it could be super fun. And you know what? As we get older, people are more likely to ignore us, at least, for a period of time. So we can be really sneaky about things. No one's going to be paying attention to the old lady, just kind of listening in on things. I'm here for that. All right, Simon, I know that you already mentioned one of your challenges in 2006, trying to figure out what the heck to write about the banking sector, but do you have any other large challenges that you can kind of think back to?
I mean, challenges every year, I guess, but I guess apart from having to work with demanding credit strategists, which of course has been an ongoing challenge, I think probably actually, the failure of Credit Suisse in 23, because that's been the most recent challenge, but also probably the biggest, simply because it was so big. There's so much debt out there. There's so many investors involved with it. So many, media headlines, and we got so many inquiries and questions and calls. It was a very intense period. So that was, in a way, that's probably the biggest challenge, I think. Yeah.
Absolutely. Well, Simon, as a credit strategist, I do have to just tell you that for the analysts, the beatings will continue until the morale improves. So you're just going to have to continue to take what we're dishing out, but know that it is all for the good of the firm, the good of CreditSights. And we all know that you three have been great for the firm, great for CreditSights. And this has been a really fun conversation. So thank you for joining us in our first episode of our special edition series of 25 for 25, celebrating CreditSights' 25th anniversary. For anyone who is listening, you can always find us by reaching out to your CreditSights sales rep or using that Ask an Analyst function. And please like, share, subscribe, spread the word of CreditSights. We make boring things like utilities apparently interesting.
We try anyway.
We try.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.